Thanks everyone for joining us for our Next Ripple Ventures Tank Talk with Uri Pomerantz, venture partner at Jackson Square Ventures, to discuss the truth about anti-hype venture investing. Thanks for joining me in the tank today, Uri.
Great to be here. Thanks, Matt.
Now, just a brief background on Uri. As I mentioned, he's a venture partner at Jackson Square Ventures, which is an early stage VC firm investing in SaaS and marketplace startups and anti-hype industries with over 400 million in AUM across 3 funds. Prior to that, he was at John Hancock, where he was the head of new ventures and strategic partnerships from 2018 to 2020, where he led investments and incubation in new fintech startups. He was also the creator and CEO of smart savings app Twine, built for couples to save and invest together. And prior to that, he started Guide Financial, which was acquired by John Hancock in 2015. Uri started his career at McKinsey & Company as an associate in the Southeast Asian office, as a strategy consultant with experience in government transformation, telecom, digital media. Let's kick things off and discuss about your consulting background, Uri. After studying at Harvard and Stanford and running a nonprofit microfinance organization, you moved to Southeast Asia to work for McKinsey as a strategy consultant. You gained experience working in government transformation, telecom, digital media, insurance, and clean tech. What were some of the lessons you learned while working overseas that you still rely on today as a venture investor?
Well, that was a fun and crazy experience, many years ago. But yeah, so many lessons there. First, just thinking about business model and market selection is really, really key for entrepreneurs. You're going to put so much of your life into starting a company, the hustle of getting it going, hiring people, getting your first customers. But really the 80-20 of it is really selecting a great business model and a great market. And so just thinking about the clients that we served at McKinsey, they tended to be very large enterprises or very large consumer companies with recurring revenue. And so one big takeaway for me, both in terms of starting a startup and also in terms of investing, is just looking for startups that stack, where the revenue stacks on each other. So, recurring revenue, B2B SaaS, or, consumer apps that have sticky revenue over time and really help with great LTV. So I think that ends up sort of risk adjusted, in my opinion, being the best kind of businesses. There's definitely entrepreneurs out there that are like, let me create the next, neobank of the world, the next sort of massive Robinhood or Chime, whatever it might be. But I tend to skew towards, how do you build the next DocuSign or the next Snowflake or the next kind of major enterprise company. Another big lesson was just focusing on the 80-20. I'd jump into projects. I remember one time working in clean tech for the first time and jumping in at 9 a.m. and had a meeting with the SVP of one of the biggest oil companies in the world a few hours later, and just, where do you start? And so with any problem, really mapping out sort of what you need to be successful. And then typically you'll have the Pareto principle there. Well, what's the 1, 2, maybe 3 things you really need to succeed, and just focusing on that, knowing that the rest is going to be somewhat of a mess or under optimized. And the last thing as well was sort of just communication. There's this thing that McKinsey loved to focus on, which I'm not sure if it was coined by them or not, but the pyramid principle. So in terms of communicating slides or just updates to folks, really starting with what's the big takeaway at the very, very top. So the conclusion, sort of the so what. And then everything in a slide is all supporting principles. So the data, the story, the rationale behind it. So someone can flip through your deck, or you can very effectively do kind of a quick elevator summary, or just run through your startup, or ask the top questions you need in a really concise way. It's a kind of a skill that you can start working on. But if you're interested, there's books on it about the pyramid principle that I found to be super valuable.
Yeah, what an experience. I always talk to people who come into operator roles in the tech world, and they usually come from a consulting background, but it's usually not the one that's the sexiest. But I find it to be the sexiest because you get exposure to so many high-level people, big decision makers very early on in your career, and you get to really learn how companies are built from the top down, which is not really the case when you're working maybe as a lawyer or a Wall Street investment banker. So it really does provide you the best fundamentals for going in to become an operator. What were some of the companies, though, that you were working with, like being built versus some of the North American jobs that you may have looked at differently?
Yeah, interesting. I think it's on that point, that's a huge thing to keep in mind. Sort of the real challenge of being an entrepreneur is you've got to simultaneously hold the very micro, the very next step, the first customers that the customer love, the MVP. At the same time, you've got to really get a sense, if you want to build a venture-backed business, why this will be, a multi-billion-dollar company, one that has, 100 million plus in annual revenue that grows at 30-40% per year for a very long time. And so I think that's one of those things where you've got to, I wouldn't spend an inordinate amount of time on sort of the later stage stuff. But when you start a company, really thinking around, okay, what public comparable companies are out there? What are they trading at? How are they doing? I generally love to, there's obviously some exceptions where there's no public company out there at all when you start, but more often than not, you're going to have some larger incumbents. And so getting a sense about, if we start this business, if we keep growing, well, obviously we need to be heads down and incremental, but what could this grow into? What are the markets valuing this? I think if you can marry both of those things, especially as a founder of a startup, that's critically important. But back in Asia, it was, at that time wasn't, maybe about, a little bit less than a decade ago. It was just, there was almost no startups in Southeast Asia and just this huge opportunity, 650 million people across all these different markets in Southeast Asia, from Indonesia to the Philippines. And it was just, there was no Amazon.com for the fourth most populous country in the world. And like me and my friends were like, do we just start this company? There was no sort of, even Rocket Internet, which comes all the way from Germany and imports people, typically expats. We're just sort of starting companies. I had a friend who started kind of the open table of Asia just a couple of years ago and just bought the sort of white label software off the shelf from a vendor in England. So it's just, there was sort of shooting fish in a barrel type thing there. That's changed a little bit over the years, but it was just really bringing great ideas and adapting them to local markets, which I think is still a big part of sort of the excitement of Southeast Asia.
Yeah, that sounds very exciting. Well, let's transition to your operating experience. So in 2012, you founded Guide Financial and eventually sold to John Hancock in 2015, where you went on to build a startup within John Hancock called Twine, which was awarded the best overall fintech mobile app in 2019. What are some of the lessons you experienced building and exiting a startup to a Fortune 500 company, and then going on to build another successful startup within a large corporation that you still rely on today?
Yeah, a great question. So, we really debated, we did a Guide Financial the very, very difficult way. We had no problem raising capital, but we intentionally raised very little. And when it came time to our Series A, we sort of half dipped our foot in Series A, but ultimately also wanted to have conversations with potential acquirers. And when we decided that was the best route, we basically burned all our bridges and really focused. So the point in there is basically, we spent the better part of a year talking to, 100, 150 different, major companies that could be interesting fit. We hired a banker, we managed the whole process, and we really burned our bridges. We sort of didn't have one foot in sort of business expansion, one foot in that area. And so I think it was simultaneously really, really scary, but also simultaneously just this clarification around, here's our goal. Let's really clearly visualize it. Let's think about the 80-20, all the work and the tasks that we need to kind of find a good fit for this company. And in the end, we were successful. We had a really good fit with a number of companies, and we're able to kind of select a great home for the company. And I think we were, Scott and I, my co-founder in that picture, we were the exception. And we actually were looking forward to really accelerating our business model with a larger company, which is not typically, happens sometimes, but it's not super typical because, we ultimately saw a big opportunity to kind of go beyond this read-only layer of giving financial advice through text messages and real-time data and actually manage money directly. And we wanted to get the resources of a large company behind it. And we found a great big company that had, were willing to throw millions of dollars a year behind this and really give us the autonomy. So the other thing we learned is, running a company is very challenging. It's very challenging within a large corporation because of all the politics and challenges. But, I think at least for the initial period of getting that started, they set us up with, do this the way you need to, hire who you need to. Here's your budget. Let us know kind of what we need further. So it's really kind of, you guys know how to do this. Let's do this together as a team, but really want to make this very autonomous. And so the dynamics of that sort of shifted a bit over the journey. And, I think if you are looking at a big company, you're going to be part of that, really making sure that you have the autonomy, you've got the shared vision, you've got alignment from the most senior leaders to make it work. And the other thing is, I think it's probably one of the biggest challenges, is around equity. So startup equity, I think in many cases, especially early, is just equivalent to a lottery ticket. But for me, it's still really matters, that idea, even though, despite the odds, you're a stakeholder in the outcome of a startup. And that was something we sort of really struggled with getting right within this larger company. We sort of looked at quasi equity and how do we make RSU equivalents to equity and what would this look like as a spin out, et cetera. And we definitely had a lot of conversations, but ultimately we never really locked into how do we retain great people? Because we were hiring people from some of the best companies in the world who were joining this 150-year-old insurance company, like people from Google and Uber and LinkedIn and all these great companies, and really wanted to sort of retain them for the long term as well. So I would say challenging, but I think the real challenge long term is just great long term alignment. I think the reason it fails is in many cases a startup within a larger company really feels like you've got one investor, and the investor is sort of a majority owner, and so ultimately you might have the best support ever, and then the investor retires and they've got a backup and something changes, and that's a dynamic that you don't have with an independent company. So I think it's generally quite challenging, but a few corporations are able to make it work.
Yeah, it sounds like you were very fortunate to have a great marriage and partnership with John Hancock, and for you to be able to leverage their platform, but have that autonomy. You still face the struggles that startups face, externally with like recruiting, applying resources and ESOP grants and all those types of things while still working at a large company like John Hancock. Now, I got to ask, with Guide Financial, were you looking to sell the company? Did you run a process? How did you guys end up getting, in bed with John Hancock?
Yeah. So I think interesting. We did startups the very, very hard way, tons of learning there. We had no problem raising capital. I think we raised like $500,000 for like 2 or 3 Skype calls. And we never had challenges going out and raising, but it was just sort of, we intentionally kept things really, really small. We're trying to get product market fit. And so me and my co-founder, we were just, pre-marriage, pre-kids, we were running around, writing all the code, talking to all the customers. It was sort of the most intense, fulfilling and overwhelming growth process in my professional life for sure. Like I would not trade the learnings of that for anything. But basically, ultimately, as we started growing with financial advisors, we had a few hundred companies using it. We had sort of a few $100 million of assets on the platform, but it was a challenging industry. We've got some sort of well-funded competition. You've got price-sensitive customers. There's all these kind of dynamics that we were growing, but it was going to be a long slog. And I saw this opportunity to say, hey, let's go and be a robo-advisor, really manage money directly, keep a stake of the assets. At that time, we would have been number 3 or 4 or 5, which if we started a robo-advisor now, it'd be number 50 or 100. And so we'd be one of the first to work with financial advisors, kind of ultimately what Betterment did and a few others. But between me and my co-founder, we really couldn't, one of us was aligned with saying kind of, let's do this for 5-10 more years. And the other one wasn't. And so ultimately, I really valued staying together. And so I said, hey, let's go out and kind of dip our foot a little bit in Series A, talk to investors. But for the most part, why don't we get a good home for this company and to just see how it works. And so it was a combination of that. We did run a process. We were scrappy. Like we work with a great sort of small M&A firm, but we negotiated fees. We changed their fee structure. We ended up doing a lot of hustle. Like they didn't know the industry that well. And so they really complimented us in terms of the corp dev process, but we were sort of the ones saying, talk to this person, talk to these companies. And when we ultimately got acquired by John Hancock, it's owned by Manulife, which you're probably familiar with, one of the largest life insurance companies in the world. I think they have 1 out of 3 Canadians as customers. And but they previously ran sort of a multi-billion-dollar acquisition process, and we were sort of a smaller startup. I'd say we were more than acqui-hire, but definitely less than a multi-billion-dollar acquisition. But they put us through the entire process. So from there's a whole corp dev team, flew out, met with all the executives. We had extensive accounting review, extensive tech review. It was sort of not sort of a weekend project. It was a multi-month diligence, and that the M&A firm was helpful in terms of navigating that, working with multiple different buyers who were interested, giving us advice, and just bringing a level of professionalism to the process. So I think it's, a lot of companies that are sort of failing or like, okay, we've only got 2 months of runway left. Let's go and engineer something and sell our assets. Like that almost never works. And so we looked at it sort of almost 18 months in advance saying, hey, we could go for our Series A, but what could this look like to get sort of a decent return for our investors from an acquisition at this point? And then all our investors were happy. They got decent returns. And we were actually happy for a number of years at John Hancock as well. So it worked out well, but I think it's just sort of really being focus on how do you build the best possible process and get partners to help.
Yeah, that's great. I mean, I'm sure your McKinsey background helped in building structure and strategy around that process. Do you want to name drop the firm that helped you through that process? Are they still around today?
I haven't talked to them in a while. They're sort of they're called Palmaris, or that was the name of the firm that we worked with at the time.
Okay.
Palmaris Advisors. I would say, in the fintech world, it depends on how big you are. I'd recommend Steve McLaughlin at FT. There's a whole bunch of others. We've worked with Moelis and others. It really depends on the size of your company and their vertical specialization. It was funny because they were more focused on historically telco. So we brought them up to speed on fintech, but they were just great strategic advisors and helped us run and structure the process.
No, that's great to hear. I'm sure we could have a whole other podcast on how to run an efficient M&A process. But let's move over to your transition to venture capital. So in 2018, you moved over to head new venture and strategic partnerships at John Hancock to invest in, partner with, and incubate new fintech startups. What was the hardest transition for you to make going from operator to venture investor, and why did you decide to take on this role?
Good question. I mean, for me, going a bit personal here, I've always been one maybe to think about life and our work in terms of purpose. Never been one to sort of take a job and say, this is just a 9 to 5 to pay the bills. And for me, I guess the soul searching process started when I was 21. I hadn't sort of built a formal meditation practice yet, but I was studying abroad on a beach and just looking for guidance. I was about to finish college. I just sat there and really kind of closed my eyes and asked for guidance. And, after what felt like an inordinate amount of time, the words create change came up. And that's sort of been this sort of directional point in my life. From there, I ended up building my first startup in the microfinance industry. But sort of for me, VC is really creating change at scale. So what you can do with venture capital at its best is really provide guidance and support and grow multiple companies at scale and really help build a portfolio where one person or one venture team can really scale impact far beyond what one individual company can do. So that's kind of what attracted me to venture, and also as an entrepreneur, being on the other side of the table, helping with guidance through the early stages, the late stage, really being an advocate. My time from consulting, kind of being behind the scenes as a supporter, was also helpful. And I guess venture was in my sort of a sphere of sort of passion for a while. I had a venture consultant or venture mentor right after college. After business school, I was close to joining a venture firm in Silicon Valley. I ended up joining McKinsey. I've sort of spent brief stints setting up kind of a venture firm in Sierra Leone after the Civil War, and then spending a summer in venture in South Africa, and then also spending a summer in China as well. So kind of had these different stints. And for me, Jackson Square was a really wonderful chance to do it in the US. And I think, in terms of your question, the hardest part, I think some of the hardest parts for me is sort of the itch of entrepreneurship, where, as an entrepreneur, you're in it, but, you're building stuff. So it's like, you've got, whether it's a week or a month or a quarter, you've got goals around shipping product or raising money or hiring or whatever it might be. With venture, it's really, really kind of almost like a PhD, completely unstructured. You could spend your time writing, talking to people, going to conferences, networking, doing all outbound directly. So it's really unstructured. And in many cases, we are a team, and a very solid team, but it's kind of a little bit, everyone's on their own, and we kind of come together at these different touch points. So it's a different vibe than sort of, rolling up your sleeves and being on a pod with a product manager and an engineer lead and a data scientist, whatever it might be. So that's been sort of part of the challenge. And I think not challenge, I think every challenge, has a potential for silver lining, but I started right in the midst of the pandemic. So I kind of closed my laptop for my last firm, put it in the mail, opened the mail up, opened another laptop, set it up, and I was just cranking. So it was a very, very surreal experience in an industry that's very apprenticeship based. So I very much still get a lot of apprenticeship. It's through Zoom for the most part, but just, every time I do a distance walk with someone, it's like these neurons light up in my head. Oh, it feels great to be around human beings and not just a 2D figure in Zoom. So, it comes down to sort of, as much as I think in any job, you want to make sure it covers your basic financial needs and aligns with really where you want to go in terms of mission and brings you to life. but it's really kind of the people on a day-to-day basis that make it really enjoyable. So that's been something I'm looking forward to next year, getting back to some face-to-face.
Yeah, absolutely. I think we all are. It's great to hear, though, that your attraction to venture was the ability for you to impact change. Venture often gets a bad rap with all the different, stories going on around the world these days, but there really is the ability to have an impact on people's lives, especially when you're like an early stage investor, when you're really helping take someone's idea and bring it to life and help accelerate the growth of that idea. There's nothing harder than trying to take an idea from scratch and turning it into a multi-billion-dollar business, and having the ability to have that impact on those people's lives and many, many other people's lives is, the reason why I called the firm Ripple Ventures. The ripple effect of that, investment of time and money into somebody can have changes on so many more people's lives than you could ever imagine. And it seems like that's what attracted you to going into the venture side. And then also have the ability to kind of go from project to project to project, scratch your itch at a bunch of different things, but obviously continuously changing what you're working on every single day was also probably pretty exciting for you, wouldn't you say?
Exactly. Yeah. And I think in that perspective, I feel like entrepreneurs are really an extension of evolution, right? We have this society where the vast majority of people, I think, right, have personalities and conditioning such that they want to plug in and sort of be a part of a team. But there's this small sliver of people that are called to start to kind of look at the world and change it. And I forget the exact details of the quote, but it's sort of like, if our ancestors, everyone just stayed inside cave and no one ventured out of cave, we'd be sitting there sort of huddled in caves right now still, right? And so I think it is sort of that breed of risk takers, of visionaries that really go out there and make the world a better place. And if you look at it as well, sort of even the sort of on the surface, a vanilla B2B SaaS product might sound like not that sexy, but it's really an extension of evolution as well. Like a DocuSign, for example, it just saves countless hours of drudgery. It saves money. It makes things more efficient and compliant. This is sort of the code that comes out of human minds that ends up getting scaled out in the world is an extension of evolution. And so, yeah, I think VCs get a really bad rap because there's just a lot of folks that are like douchebags or a-hole, just sort of forget the privilege it is to be able to kind of be stewards of capital and allocate it effectively and forget what it's like to be an entrepreneur. And so there's, every now and then I'm on a call with another VC, they're texting kind of what's going on here or this, or kind of very negative comments about an entrepreneur mid-pitch. I'm not one to avoid kind of critical feedback, but just the sort of, a lot of that comes with this air of superiority and an air of kind of judgmentalism that I think is sort of, you marry that with sort of people that are otherwise would have gone into like finance jobs or whatever was trending at the time, and you get sort of a bad rap. And there are a number of VCs like that. But I think generally there's a lot of folks that are also professional and really pride themselves in this work and feel called to it. Don't get me wrong. It's ultimately there, an important part of it is making great returns and making great investments. But for me, it's sort of the adding to that, why would one want to spend an inordinate amount of years with a company? It's sort of that alignment to what they're doing.
Yeah. I mean, it's a long marriage for sure. And I think, what I see as well is the empowering of the rebels in business sense, right? Like Steve Jobs said, like you are basically, the chain breakers who don't want to fit the mold of going through the same, career path that everyone before them had walked. Is our privilege to be able to sit beside them and empower them to be rebellious against the formal structure of business that has been around for, 20, 50 years is a really exciting place to be. And I'm excited to be along the ride with you. So let's talk about your transition to Jackson Square, where, they recently just closed their third fund with 193 million. They've got 400 million in assets under management across 3 funds. Can you tell us why you joined JSV and what excited you most about joining such an established firm?
Yeah, I mean, a bunch of reasons. I think the 80-20 here is people and approach. So the people ultimately, as I said, very much an apprenticeship business. You go into it, there's just, if you view the human mind as this neural network, right? We're sort of starting with a little bit of randomized weights and then it gets tuned and suddenly it starts getting accurate over time. But, same thing with venture. It's really, it does take a lot to start a venture firm, but there's a whole number of venture firms that just get sucked into the hype, sucked into sort of momentum and really forget fundamentals. So this team is a team that really attracted me for a number of reasons. First, everyone on the team was either a founder or operator. So we've got folks that were chief information officers at Cisco, senior leaders at Apple, started multiple publicly listed companies, very successful entrepreneurs and operators. Everyone on our team has experience either leading companies or starting and then leading them as well. So really kind of can walk the walk, and it just provides great perspective and able to commiserate with entrepreneurs. And two is sort of a lot about this firm is anti-hype. So Jackson Square has got a good reputation. It's not sort of the most well-known brand, but it's very successful in what we've done. So in terms of, each of us will do 1 or 2 investments per year. So very high conviction and a very high success rate of what we've done as well. So really part of that is not just getting the, cracking the code in terms of sourcing and selection and sort of pulling the trigger, right. But really sticking with companies for the long term. So, Pete, one of the co-founders of the firm, was one of the first checks into DocuSign. Has been sitting on the board for I don't know how many years, over a decade or more, all the way through to a $40 billion plus publicly listed company, and definitely doesn't have to do that anymore. In terms of he's added so much value and guidance through kind of multiple CEOs. But he still cares. He's still involved, still adding a ton of value. Greg, another co-founder as well. Similar story with Upwork. Very early in that team, and still involved with it. Sort of many multi-billions of valuations later, public listed, and sort of many like that. So it's one of those things that I think almost every VC says, but it's sort of, we really walk the talk, and we do that by really sticking with companies for the long term. And I've seen it behind the scenes where, we're continuously do portfolio review, how are companies doing, sharing the good, bad, and ugly. And a big part of that is really, for example, being very mindful about reserves. So just saying, hey, how much can we realistically allocate at this point, and being very cautious about that, wanting to both use it in a very kind of progressive way when things are going well, let's double down, but also planning for the inevitable. And, things go sideways sometimes, pandemics hit unexpectedly. And so being really thoughtful around wanting to bridge companies. And I've seen that sort of multiple times where we've successfully turned around companies that look sideways, and suddenly, a few $1 million later and 6 to 12 months later, with the right strategy, they've closed some massive companies, their revenue's back on board. Either they're sort of in a position to raise at an up round, or if they want to sell, we're going to get sort of a multiple of what it would have been before. So really thoughtful. And I would say everyone's professional and ethical. There's not that sense around haughtiness or arrogance. It's a very humble place. So I've really enjoyed that. And it's also very entrepreneurial. Everyone's a partner. We all go, we find our own deals. We work together as a team, but we don't have this massive platform team as well. So it's very entrepreneurial as well.
Yeah, it sounds like an excellent place for you to be, especially as a former operator and then running ventures at a Fortune 500 company. But let's talk about the anti-hype nature of JSV and the truth about anti-hype venture investing. How does JSV define anti-hype venture investing, and why is it such a focus for the team?
Yeah, great question. I would say anti-hype is beautiful in the sense of, I guess it when you see it. And so it's difficult to exactly pin down. Everyone's got a slightly different definition of it. I think, for me, it's really high conviction and non-consensus. So, high conviction, what that means is really, each of us wanting to really fall in love is the wrong term, but to really want to make something happen, want to make an investment happen, and commit to a company in the long term, and really get the rest of the partnership around that. So it's sort of doing the work. And again, nothing is perfect. Some of the best investments had technology teams had to be completely rewritten, and a bunch of folks had to be hired, and teams changed. But really getting to very high conviction, and sort of the intersection of that with where there's not a lot of buzz or momentum or kind of hype in the market. So I think usually, not always, but we definitely win the bulk of our deals. But some of our best investments have been sort of high conviction and not super crowded. And so we've seen that in different places. We've seen it in places where people underestimate market size, and we sort of build an N of one SaaS business that becomes really interesting. We've done that with companies like DocuSign, where there was half a dozen competitors at the time of the investment. We still did it. There was a whole bunch of changes made over time, but just sort of won through a bunch of hard work. And we've done it also through working with our networks, people that we've worked with in the past who trust us, who want to work together, and kind of refer other friends starting companies. So I think that's kind of what anti-hype means to us. It tends to be very, I would say, not always, but, boring, sort of non-sexy industries where you're not going to have your 21-year-old, in Canada, Waterloo grad or whatever, starting companies. It tends to be folks that have a big mission, deep domain expertise, understand sort of all the companies that have made mistakes in the industry and still want to go and do something differently. That tends to be a really good bet as well. So I think it's really kind of looking at sort of what we really believe in and what a lot of people don't believe in or what they're not seeing yet. And I think something else that we pride ourselves on in that also is, we'll ask around sort of previous investors or who's knocking at the table for a certain round just to get a sense of dynamics. But we very much are not influenced by, okay, X firm is doing this or X firm is not doing this. That really doesn't influence our decision. I think that really helps to make great bets, right? And the same thing applies for public markets as they do sort of much earlier stage. And so it's really sort of getting back to the fundamentals, which at this current time, I think we're sort of an interesting 2020 vintage where there's a lot of macro challenges and suffering and issues, but public markets and private tech markets are really doing well. And so I think it's getting in at good value, getting into businesses that can kind of have stacking revenue, that have good network effects, that are very simple to understand, just the fundamentals here, and not getting too distracted by the latest shiny object.
Yeah, I think we think along the same lines at Ripple. It's those non-sexy industries that we kind of call it, whether it's healthcare services or construction, logistics, things like that. I find that we don't have much competition in the deals that we're going after because they're not in that hype area. They don't have the Ivy League CEO, and they're going after, large TAMs, but they're just not really large at the time that they're selling into them because people don't really aggregate all the tertiary markets they could sell into, which I think is really important. And it's great, obviously. I mean, if 100 firms have passed on a deal, that doesn't make it less interesting to you, it sounds like, right?
Yeah, exactly. So I think it's, it's a question that we never ask, like who has passed on this or where is it in the cycle? We love seeing things early. And I think some of our best deals come from successful entrepreneurs that go to us first. So if we've been around for a number of years with folks and they love us, like we'll get great access to deals that way. And that's fantastic. For example, the vast majority of our deals are sort of US based. We've done a number of Canada investments, but occasionally, Greg, for example, through his networks and friendships, worked with an entrepreneur and made an investment in basically the Instacart of Latin America, Corner Shop. And, that's something that we don't generally do. But when there's a very strong personal connection, we know someone really well, we've got some kind of outsized advantage, we'll make that bet. And it's worked really well. In that case and a number of other cases too.
Oh, that's awesome. Let's talk about some of those great investments that you've made. So GSV has backed some incredible businesses, as you mentioned, such as DocuSign, Upwork, and Strava. Given the anti-hype thesis and the firm's focus on stable companies with strong teams attacking large, sometimes boring markets, how hard is it to avoid investing in hyped up industries when the opportunities are so massive?
Yeah, I would say actually not that hard. Here's my perspective. Coming in new on the team this year is sort of in a pleasant way. I've been surprised how hard or how high the bar is internally. I think it's a good thing. For any founders, entrepreneurs hearing this and pitching VCs, know that a lot of VCs are going to pass. And having seen it from both sides of the table, it does not mean you have a bad business. It does not mean you can't even build a great business. I just got very excited about a company, a couple of weeks ago that was revolutionizing the solar sort of the electric vehicle industry, working with utilities and a software only solution with a great team with deep domain expertise and decent early customers. But the conversation that we had was sort of, okay, fine. Great software solution, customers love it. We see a path to growth. But when you start stacking on things like TAM, or you start saying, hey, this could be decent outcome at a 400, 500 million. But if we're getting in at, call it like 40, 50 pre-money valuation and owning a small percent of the company, it's not going to be a great return for us. So I think the bar is just, for entrepreneurs, don't be discouraged. First, you can build a great lifestyle or sort of a business that you never raise venture funding for, or you can raise sort of pre-seed, seed, even Series A money and have a few $100 million exit, $500 million exit. Fantastic for you, fantastic for your early investors. Probably not fantastic for a firm like us. And given our economic structure. And so it's really, the bar is sort of at a minimum, like, can this be sort of a few $1 billion market cap company? If not, sort of, what does it take to be 10 billion plus? And so it's really not just, we sort of talk about the term 100 million annual revenue growing at 30%. That's really the starting point. We have companies that are sort of far, far beyond that. So actually it's been, I would say we skew on the side of passing. We don't have to kind of be in every single multi-billion dollar unicorn potential deal. We can definitely miss a lot of those, get a 10 or 15x and do really great, do great by our companies, help them grow at a pace that makes sense for them, help them stay not super diluted, and really be partners for the long run. So that's kind of our model there. And so I'd say, because we've done, especially with Pete and Greg, the founders of the firm who've been doing this for a couple of decades and on their fund 8 now, they've just seen so much. That's like, oh, here's clean tech 1.0. We're at 2.0 now. Most of these problems are still here, whatever it might be, that it's easy to kind of say, well, if you've got a term sheet that's 20 or 30 million more than we're willing to do, congratulations, like, take it. It's a good offer. And so it actually hasn't been super hard to kind of stick to our guns. And I think whenever we've strayed, more often than not, we end up kind of paying a price for it.
Yeah, that's a really good point, to stick to your thesis, stick to your vision, say no to 99.99% of the things that come your way. But also important for entrepreneurs to hear that just because you say no to an investment doesn't mean you have a bad business. There's a difference between a bad investment and a bad business. You could be a bad investment for a venture fund, but you could still build a great business. But also on the flip side, you could have a bad business, but a great investment, because the upside can be so large if you do end up hitting that lottery ticket. And that's sometimes what venture investors look for. So don't always try to make sense of what you're selling to a venture fund if they say no. It's just that it doesn't align with what their model is, right?
Exactly. Yeah, I think it's, and we have one flavor of venture model here. And you might hear this and say, this is awesome. I want to build a business with fundamental value. I want to do this for the long term. Or you might say, I want to sort of make as much money as I can in the next 3 years and do whatever I want to do next, which is totally fine. There's a whole fair share of momentum investors that are, there's sort of generally this, not with us, but I think with a lot of investors, this pull around as you get to like later stages. Let's put more money into marketing. Let's run on kind of negative margins for a very, very long time. And let's go and follow the Uber playbook or whatever it might be, and just get a lot of market share quickly. Some might argue that's good. Some might argue it's bad. I would just say it really it depends on your fit, your preferences as a leader of a startup with your investors. You have this if you're aligned with your investors, you want to go big, you want to go fast, you don't mind being unprofitable for a very long time, and it's a momentum play, that could make sense for some business models. I think for a lot, especially coming out of 2020, where we've just seen sort of just massive shifts in the market quickly, I think sticking to kind of fundamental customer value makes sense, but it really is alignment with your investors. You look at sort of some of, in Andreessen or somewhere else, they really, not picking on them, but firms like that with larger fund sizes, they can basically be less valuation sensitive, but also I would argue they sort of make a lot more bets, and you might get a lot less attention if you're not sort of the top 5% performer in their portfolio. Though great team, great approach as well. So there's really a fit with your personality, your vision, and whether you're kind of the same with public markets, more of a momentum type of founder where you want to grow big, really, really fast at all costs, and then sort of run it to the wall. And if it blows up, fine, do the next thing. We're very much sort of avoiding hitting a wall at 100 miles an hour. We're very much, what's the right tempo to grow your business, and where do you want to be in 5 years, 10 years?
Yeah, it's like what Vili at Two Sigma says. It's partner, founder, fit. What's the partner utility curve? Where are they at in their journey in investing in rocket ships or investing in a traditional B2B SaaS business? A lot of people could have said, WeWork was a bad business, but a great investment. But that's because the investors were looking for a huge, 1,000x return investment, even if the business fundamentally didn't make sense. And so it just really depends on finding the fit between the two. So given that half of JSV's deals are outside of Silicon Valley and that you frequently invest in first-time founders, How do you see the future of venture capital changing as more first-time founders are rethinking moving to the Bay Area?
Great question. I mean, to be candid, it's a little bit like, I don't think no one knows yet. In reflecting a little bit on sort of recent trends in the Bay Area, my sense is essentially a great location is a combination of great education. So people coming out of good schools and sort of young hires that have technical talent, and then funding pools. So do you have angel investors at scale there? Do you have pre-seed funds, seed funds, more institutional capital investors there as well? So historically, obviously, the Bay has been massive, but I think, what feels kind of inevitable is you're going to have more of a shift to different hubs. You're going to have Austin will grow, probably Portland, Denver, to a lesser extent Miami. I'm hoping places like Toronto and other hubs in Canada will grow. That feels inevitable. What I feel is sort of not inevitable is, we will also have a snapback. Human memory is very short. There'll be a period of time, maybe in the next 12 months, where the pandemic feels somewhat forgotten, and we're sort of back to a regular stretch of what life felt like before. And so I think great founders are ones that don't just sort of want to minimize cost and minimize risk and like not fail, but people that really, how can you maximize your odds of succeeding? So I think if over time you start getting more funding pools and great talent in place outside the Bay Area, I could see it being more attractive for a lot of folks. But I think if you still want to, really, really hit it big, you want to be in a major hub. And so I think it's hard to exactly tell, but I think the hype about everyone leaving California is a bit overrated. I think we're going to probably see something in the order of, some shift of magnitude, 20 or 30%, which I think could be a good thing. But ultimately, it's a really kind of long-term journey. Like Silicon Valley and a few other hubs were really kind of the story of schools, government investments, people in the right place, funding networks, and multiple years of people starting companies, then becoming investors, starting the next generation of companies. And so I think it takes a while to build that ecosystem.
Yeah, it definitely does. It definitely starts with the education, the government support, and the angel groups. Fortunately, we have all three of those in Toronto and in other areas in Canada. So I feel very lucky to be a venture investor in this ecosystem. But we've been finding companies, in the US and in Utah, in Seattle, Chicago, in Vancouver, Canada. We've also seen some really great bootstrap startups that nobody's even heard of yet. So maybe we'll see, 25% of the founders that were thinking to go to the Bay Area to build their companies maybe stay closer to home or in other areas outside of that. But I do think you're right. It definitely has to do with what is the core base like of the investor group and the academic community and things like that. I want to talk about the microfinance business that you built. So in 2003, you co-founded Jazur Microfinance as a nonprofit microfinancing company focused on providing loans to help unemployed Palestinian and Israeli youths create new businesses in their communities. Besides being an incredible initiative, what were some of the lessons you learned from that experience, and where do you see the largest opportunities to invest in this area in the future?
Yeah, thanks for asking. I would say that was what I learned was in that one. Ultimately, it was sort of a personal tragedy in my family. My great aunt was killed by a Palestinian terrorist in Jerusalem, and I was just wanting to use that tragedy to do something good, and that was like my entree into entrepreneurship. And so ended up starting a microfinance nonprofit, working with Israelis and Palestinians, one of the first of its kind there. We were the first partner for Kiva. We ended up getting, the future Palestinian prime minister, working with the national security advisor of Israel, and just this sort of crazy whirlwind of experience. I guess I had a bunch of learnings there. First is, basically when you have a mission you're passionate about, like nothing in the world can stop you. So it's really kind of alignment with, I don't know if you read the book Mastery or not, but sort of this sense of each of us have this like sort of kernel seed of why we're here as human beings. And we're all sort of unique based on our genetic code and circumstances. And this was one of those moments in my life where I felt very much called to this work. And people just started showing up around. There was sort of almost of its own volition. Co-founders came in the mix. We were getting sort of multi-$1,000 checks in the mail from strangers. We were on CNN when we were 21, just winning all these, competitions. And it was just this really kind of interesting momentum building thing that was sort of building on itself. That was really interesting. Two, you don't need to be qualified to start. I think, especially when you're not qualified, when you have the idea of whether it's building a venture fund or building a startup or, something in your family or whatever it might be, a side project, you have passion, but you don't have the skills. just getting started is the most important step. And like, it's sort of, anything that you immerse yourself into with that passion, you're going to just ramp up over time. So it's a little bit trite advice, but it is really, really true that if you really are drawn to something, you'll spend more time on it and you're going to get outsized results. And then from a personal perspective, there's really, in terms of how do we as human beings feel a great sense of well-being and happiness. And for me, there's been very few experiences greater than contribution. So doing something, this was a nonprofit. Ultimately, we enjoyed working on it. We enjoyed a lot of sort of writing about it and talking about it, but ultimately it was for other people. And sort of there's few activities you can do in your life that sort of give you the satisfaction of helping others. And so that's a good reminder of, personally, I don't think my life is complete without some kind of activity that's outside of myself, my own kind of individual needs and preferences and that kind of stuff. So interesting, fascinating experience, and just real love of like fintech starting from that, this love of like kind of getting people up the financial ladder out of abject poverty and using technology for good. Opportunities now, I think it's interesting. Like, back in the day, it was sort of Mohammed Yunus who started Grameen Bank, and microfinance was a big thing, and Kiva was just starting. Now, if you do a bunch of research on microfinance, you'll find some stuff, but not very much. It's sort of a World Bank paper here or there. The reality is microfinance is everything, and we're just not calling it microfinance anymore. It's sort of, you might say microfinance is sort of fintech for emerging markets, or fintech for lower middle class. It's what banks are doing around the world. It's what fintech startups are doing around the world. And so I think there's lots of opportunities. I'm always sort of a sucker for sort of holistic plays, plays that start in one area, but ultimately have the potential to kind of do multiple things for that customer. So, I think in the lens of microfinance, if you're dealing with a family or a small business owner, they have multiple needs. From, lending is a very, very important need, giving, access to capital at efficient rates in a way that's easy. And then sort of combining that with insurance, getting people disability and life insurance, and getting up the financial ladder from there. Then you can build onto savings and retirement. And so that whole story, when you can kind of stack insurance plus lending plus savings and investing and other things for a vertical, whether it's a small business owner, whether it's a family, those are really interesting plays. And I think in the US, for example, you've seen that with SoFi, which has sort of started with sort of they call their customers Henrys, high earners, not rich yet. And they started with student loans and then kind of naturally expanded to all sorts of different needs, right? So mortgages, some quick, high quality credit, short-term credit, savings accounts. They have a robo-advisor. They're doing retirement stuff all over the place. And so I think they look at themselves sort of a customer-driven company, which is sort of what are the natural needs of our customers and how do we expand there versus we're going to launch these products. And I think that same play is available in emerging microfinance. You have Tala doing that on the loan side. You've got Branch as well. You've got Bima doing micro insurance, companies distributing through telcos. There's a lot happening there, but no one that's really brought it all together yet.
Wow. I love this story. One, taking a personal tragedy and turning it into a passion project with a mission probably helped you understand what a mission-driven founder really looks like and feels like when you find them today. And also how you actually took something, brought it to the community, and then saw the way it spread itself through the community for change can now be used in ways that you look at businesses and how they can go into different markets when they don't even think about going into those markets the second, you give them that first check, which is something that, every outside investor probably looks at. It's like, why are they going into a business that everyone else is competing in? Well, it's because if they can find a way to create a little bit of a niche community with just a little bit of a product, they can start to sell more and more offerings outside of that. And that is the definition of like microfinance, pre-seed investing is like the same thing, right? It's like you're not even betting on what it's going to look like in 10 years. You're betting on just getting started and then how many ripples they can create outside of that first investment, which is really cool. I really want to talk about this time you spent in Sierra Leone and Africa. So you spent some time helping set up VCs in Africa and China, and have worked with multinationals around the world to develop their own venture capital investment industries. Where do you think the best emerging markets are today to invest? And how can venture funds start investing in those areas if they don't have a local presence?
Yeah, a great question. I think it's two questions in there. I think on the first one, where is the best emerging markets? I mean, it's a very nuanced question. It sort of depends on, are you starting a company? Are you doing public markets investing? But taking the founder angle, I think it's really pick a market that you understand or you could see the opportunity in. If not, you have to really, I think it's to really immerse yourself in those markets. I have a friend, Ron Hose, who I knew from Israel years ago, who started one of the more successful Bitcoin companies in Southeast Asia, moved to Philippines. But he sort of started by moving out there and sort of spending time there, immersing himself in that culture, and then seeing the problems and working on the solution. So I'm definitely, I would say, if you've got a country or region that's big enough, if you speak Spanish or passionate about Latin America, a pan Latin America play could be interesting. Pan Africa plays could be interesting if you've got a connection there or passion. I think Southeast Asia, I'm like sort of most biased for that. I think it's one of the best opportunities because 600 million people across the region. You've got Indonesia and Malaysia and the Philippines and Vietnam, just tons of countries that you can kind of customize local strategies for. I think it's a great place. You can be based in Singapore where they speak English. It's really easy to move as an expat. That's great. Obviously, China is going to be massive, but I think China is, unless you're Chinese and you have deep connections there, it's a harder market to break into. You've got to really work with great allies in government and local partners there. So I think China's pretty out for China natives, in my opinion. So I think, I was biased towards Southeast Asia because people there's sort of this massive emerging middle class. People were getting online for the first time. Payment networks need to be built. There's a big opportunity to kind of help people up the financial ladder, and then also just products that bring joy to people's lives. And so I think it's a great market. But even there, it's really a story of, do you really start in Singapore because it's just a few million people? How do you actually really get growth in like an Indonesia with a Malaysia or a Philippines to really get things to be at scale? So I think it's more of a challenge of, if you're not in the US or Canada, where you got these sort of massive markets, how do you get to tens of millions of customers? And you really need to do that across multiple countries.
It sounds like you need some type of local connection, a foot in the door, some type of passion towards helping that community. You can't just sort of spray and pray your way around an emerging market as an investor.
Yeah, I think so. Even like Rocket Internet, that might be the closest example of these guys sitting in Germany, and they eventually had a big presence in Southeast Asia. Even then, they could see the high level ideas that they wanted to emulate there, but they hired people on the ground, locals or people that had sort of expats that have lived there for years. They actually hired a bunch of folks, my colleagues from McKinsey, to run different companies there as well. But you need people that kind of understand local markets, at a minimum live there. I mean, to your other question, how do you get involved without being there? I think the answer is, you need to, if you're going to be really active starting something or really hands-on, you need to be there. And short of that, there might be an opportunity for more of kind of a syndicate approach, where you've got a friend or someone you trust there. You can basically co-invest or build a syndicate or some kind of way of sort of learning as you go there. But I think it's very much, maybe the story changed on this, but historically it's been near impossible to invest effectively without being in a local market. Perhaps with the pandemic, with everyone going remote and Zoom, it becomes possible to do things that you never could do before. But I think at least it really depends on the kind of business you're running, how, to what extent you're doing sort of hands-on biz dev and everything else. But I think it's way more challenging if you or someone that you partner with isn't local.
Yeah, I think for now, Ripple's probably going to stick to Canada and the US, and maybe we'll end up in India or Singapore in the next couple of years with your help, hopefully. So yeah. I'd love to move to my favorite part of the talk, which are your book recommendations. And you've got 4 amazing books here. Can you tell us about each one of these and why our audience should give them a read?
Sure. The first one, Man's Search for Meaning by Viktor Frankl, is just about broader perspective. Whenever, human beings, myself included, whenever I'm in a contracted state, is just getting perspective around, this is someone who went through the Holocaust and Auschwitz as a psychologist and really asked himself the question of, why did some people go through the same experience and just basically give up hope and die? And how did some people thrive? So just this incredible perspective around, when you're complaining about your life, why isn't things this way? Or why is this challenging or whatever it is? I always like to pick this up every couple of months and put it in perspective. I actually have a picture of shoes at Auschwitz. It sounds kind of depressing, but I have it in my closet to be like, hey, no matter what's happening, no matter what I'm spinning negatively on, put it in perspective, appreciate that I'm alive, I'm here, that I have these opportunities. The next one is Essentialism, actually written by a classmate, friend of mine, Greg McCowan from grad school. Just a fantastic book. I have a tendency to kind of do a million different things. I'm not sure if other folks feel the same, but this is sort of a question around what are the few things that really matter in your life? How do you really focus on those? And the art of saying no, the art of focus, the art of just being great at a couple of things. Just a really inspiring, impactful book. And there's a good Tim Ferriss podcast interview with him as well. The third book, Nonviolent Communication, still getting through and mastering this, but basically it's you know, as human beings, we all have different needs, whether it's at work, with our co-founders, with our investors, families, friends. How do we express our needs in a way that sort of lets people know kind of, hey, this is on my side of the table. Here's how I'm feeling. Here are my needs. Here's what I'm observing, and making requests in a way that are really kind of allows people the maximum chance of hearing you without getting triggered, and the maximum chance of making your relationships more wonderful with others. So it sounds very Northern California, but it's a really powerful framework of 4 different steps you can take in having any feedback or request conversation. That's fantastic. And then Untethered Soul, just for some reason, this book just resonated deeply with me in terms of, you know, why are we here as human beings? What is existence? What is this life? And there's a chapter towards the end where he talks about the path of unconditional happiness, which I sort of my go-to on many days, sort of conditioned to look at the world and say, when things are a certain way, then I will be happy. But really that happiness can start from within, and sort of this idea of, if you can set for yourself this goal of, I'm going to be unconditionally happy or content or unconditional acceptance of life, no matter what happens in the external world, and then flow from that place. It's a real challenge to do that. Not saying this is easy, but sort of as a place that I strive to get to. It's a real powerful chapter that he gets to kind of later in the book about this path of how you as a CEO or founder or investor or just a partner, how you can actually go through life with the kind of cultivate the best mentality internally before you go out there and do your work.
Yeah, I love all these book suggestions because, one, they have nothing to do with business, but they have everything to do with being a good person, good humanity, and the way to look at life and think about life, especially, you know, now with all the, you know, depression and stuff going on with COVID. Books like Man's Search for Meaning really put things in perspective with what people had to go through, you know, in the last century that currently we're experiencing now, and help you get through these things. So thank you very much for sharing those. Now, before we wrap up, we always ask our guests for any final words of inspiration for our audience.
Yeah. So basically I would just say, well, first I wanted to mention that last one. We also have a book club as well. So it's jsv.com/books. And we have books that we go through every couple of months, often with authors. So if entrepreneurs want to join and get synced up with us, they should join that as well. And inspiration for our audience is really kind of what I was talking about previously. The quality of your mindset informs the quality of your work. So I think whenever you can, figure out the stuff that really makes you the best person you can be, whether it's meditating or working out or the right music or the right people around, whatever it might be. Take care of yourself first. And it sounds selfish, but kind of get to a beautiful place internally first, or the best place you can get to on a given day, and then go out there and do your work. And that makes a ton of a difference.
Yeah, absolutely love that. And it's like they say on the airplane, put your mask on first before helping others. It really is, because you're no good to anybody else if you can't take care of yourself first. So I appreciate you taking the time to join us in the tank today, Uri, and sharing your words of wisdom and your thoughts on the truth about anti-hype investing in venture. So thanks so much for taking the time today.
Pleasure.